Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TIANJINPORT Development Holdings Limited annual report. TIANJINPORT Development Holdings Limited offers a diverse range of businesses and services at the port of Tianjin in China. The company's primary segments include cargo handling, sales, and other port ancillary services. The cargo handling segment provides two types of cargo handling services: containerized and non-containerized cargo handling. This includes the movement and storage of goods such as containers, bulk commodities, and project cargo. In addition to cargo handling, the company also offers a variety of sales-related services. These include the supply of fuel and the sale of materials, which cater to the needs of ships and other vessels visiting the port. The other port ancillary services segment provides a range of support services that are essential for the smooth operation of the port. This includes tugboat services, agency services, tallying services, and other miscellaneous services. Furthermore, TIANJINPORT Development Holdings Limited also offers warehousing and logistics services to its customers. These services enable companies to store their goods safely and efficiently while they are in transit or awaiting shipment. The company's treasury services provide financial support to its clients, helping them to manage their cash flow and make informed investment decisions. Other ancillary services offered by the company include customs clearance, freight forwarding, and marine surveying. Overall, TIANJINPORT Development Holdings Limited provides a comprehensive range of businesses and services that cater to the needs of ships, cargo owners, and other stakeholders at the port of Tianjin. TIANJINPORT Development Holdings Limited market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $30 billion. TIANJINPORT Development Holdings Limited trades at a lower price-to-earnings ratio of 7 times and a lower price-to-book ratio of 0.28 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.97%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key performance indicators and market trends. On the growth side, cargo handling has been a significant contributor, with a 51% increase in revenue due to increased demand for shipping services. Additionally, sales business in other port ancillary services segment has seen a substantial rise, driven by the expansion of container handling business and an increase in throughput of non-containerized cargo handling. The growth of container handling business is also noteworthy, with a 13.9% increase in revenue due to higher volumes and improved pricing. Furthermore, the blended average unit price of container handling business has seen an 11.8% increase in Hong Kong dollars, contributing to overall revenue growth. On the other hand, the primary drivers of revenue decline are more complex and multifaceted. The disposal of Zhangti Storage and Transportation, a key operator in the sales business segment, has had a significant impact on revenue. The disposal of assets by TIANJINPORT CNAF Terminal Co., Limited, has also contributed to the decline, although this is a one-off loss rather than an ongoing trend. Finally, the discontinued operation of the sales business segment has resulted in a 0.2% decrease in revenue. Overall, while there are multiple factors contributing to revenue growth and decline, cargo handling and container handling business have been key drivers of growth, while the disposal of assets and discontinued operations have contributed to decline. The company's net income saw a significant boost of $96 million, indicating a positive trend in its financial performance. However, this growth was not mirrored in the profit margins, which experienced a decline. The gross profit margin decreased by 1.5 percentage points to 34.6%, while overall profit margins also suffered due to increased operating costs associated with other port ancillary services. This discrepancy highlights that despite the increase in net income, the company's ability to retain profits as a proportion of revenue has actually diminished. The company's financial performance indicates a strong ability to generate cash from its core operations. A positive operating cash flow is a key indicator of a company's financial health, as it suggests that the business is generating sufficient revenue to cover its expenses and invest in growth opportunities. According to the provided data, the company's operating cash flow for 2025 is $24,018, which is a significant amount. Furthermore, the net cash inflow from operating activities is $1,757 million, indicating that the company is generating substantial cash from its core operations. This positive trend suggests that the company is well-positioned to continue investing in its business and driving growth. The company has experienced a significant reduction in its debt level and interest expenses over the past year. A review of the financial data reveals that non-current borrowings, current borrowings, and lease liabilities have all decreased by substantial amounts. Specifically, non-current borrowings dropped by $174,145, while current borrowings fell by $160,438. Lease liabilities also saw a decline of $161,430. The decrease in debt level has had a direct impact on the company's interest expenses. Interest expenses on borrowings decreased by 32.4% to $72,318, and interest expenses on lease liabilities dropped by 33.3% to $1,202. Furthermore, finance costs as a whole declined by 32.2%, from $148 million to $168 million. These reductions indicate that the company has successfully managed its debt and is now paying less in interest expenses, which should have a positive impact on its bottom line. The financial performance of various segments and regions within the company has been analyzed. The cargo handling segment stood out as a top performer, generating $4,052,578 in profit. Similarly, the sales segment also showed impressive results with a profit of $1,154,310. Other port ancillary services segment experienced revenue growth of 10.8% in HK dollar and 11.1% in RMB, indicating a positive trend. On the other hand, discontinued operations failed to provide any segment results or reported losses, indicating poor performance. The sales business also showed a decline of 0.2% in HK dollar, contributing to its poor performance. Administrative expenses for subtotal stood at $82,750, further highlighting the financial struggles within certain segments. The performance of Hong Kong region is unclear, but it appears to be a significant contributor based on revenue figures. Management is emphasizing a strategic shift towards core business activities. This focus on the company's fundamental operations aims to streamline processes and maximize productivity. To achieve this goal, management plans to enhance quality and efficiency across all aspects of the business. A key driver of this strategy is innovation, which will be leveraged to bolster competitiveness in the market. By investing in cutting-edge technologies and practices, the company can stay ahead of industry trends and maintain its position as a leader. Furthermore, management has prioritized quality and efficiency, recognizing that these elements are crucial for long-term success. In addition to driving innovation, management is committed to promoting qualitative improvements in production and operations. This involves controlling risks and implementing measures to minimize waste and maximize output. By doing so, the company can reduce costs, improve customer satisfaction, and ultimately drive growth and profitability. The company's financial records clearly indicate its commitment to rewarding shareholders through dividend payments. A proposed final dividend for 2025 was set at a substantial amount of $166,641,000, demonstrating the company's confidence in its financial performance. Furthermore, a recognized distribution during the year ended 31 December 2025, representing the final dividend of 2024, stood at $175,878,000. These figures confirm that the company has indeed paid dividends to its shareholders, showcasing its dedication to shareholder value creation. That concludes the financial summary for Tianjin Port Development Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.